Here, I wanted to cover some basics of bonds. As simple as they are, some concepts about bonds can be quite confusing sometimes. So, when that happens, I usually want to remind myself that fundamentally, everything about bonds is just about cash flows. We'll start with a simple setup to explain the basic parameters that define a bond, including the time to maturity, coupon rate, coupon payment frequency, and the par value, also called face value and principal. Then we'll review some derived values, including price, which is present value, yield to maturity, duration, in particular Macaulay duration, and par rate. We'll use the following example. This is a 5-year bond with 5% coupon rate, and the coupon is paid twice a year, and the par value is $100. What does that mean? Remember, everything is about cash flows. Let's sketch out the cash flow in this case. Once you purchase the bond, you will get the par value back plus the coupons within 5 years. Every half a year, you will get $2.5 since the coupon rate is 5%, which is annualized. At the end of the 5-year period, you will get the par value $100 plus the final coupon $2.5. So the cash flows are pretty simple and straightforward. But in order to calculate the value of the bond, we need to discount the cash flows. The price, or the present value of the bond, is the sum of all the cash flows discounted to present. Since $2.5 in the future is not worth $2.5 at present, usually. The discount factors are usually given by the current treasury rate, which can be bootstrapped from the market treasury bill and bond prices. What is yield to maturity, YTM? Note this cannot be confused with the coupon rate. Yield to maturity is a derived value from current price. You can consider it some sort of average interest rate if you hold the bond until maturity. That's a little confusing. It's probably easier to look at the formula directly. The price is determined by the discount factor, and this does not equal to 1 over 1 plus y halved. Because the yield to maturity is a single parameter for all the periods, while the discount rate is different for different periods. For example, the 2-year rate and 10-year rate are really the same. If the discount rate is constant over time, then yield to maturity would be equal to that. Duration of a bond is basically some effective maturity. We'll look at the so-called Macaulay duration. It's cash flow weighted average maturity, meaning for every payment period, you weight the time by the discounted cash flows, and you normalize the sum with the total discounted cash flow, which is just the price or present value. Again, looking at the cash flows with coupons paid before time to maturity and the final payment of 1 coupon plus the principal at time to maturity, it is clear the effective maturity is shorter than time to maturity, 5 years in this case, since we are getting coupon payment earlier. An interesting question is, if you increase the coupon rate, everything else being equal, what happens to the Macaulay duration? Is it shorter or is it longer? Looking at the cash flows again, if we sketch it out, for example, assuming the coupon rate has doubled, it's clear we are getting more money, relatively speaking, at earlier times, since the principal stays the same, still $100. So the effective maturity, the cash flow weighted average maturity, should be shorter. Finally, what is the so-called par rate? Par rate is the yield to maturity when the bond price is equal to the par value, and it happens to equal coupon rate without setup. We can verify this. Write down the price using the formula with yield to maturity, assuming it's the same as coupon rate. Here, remember to multiply it by the par value. With geometric series, we can easily confirm this results in 1 times par value. So it happens to equal coupon rate without setup. In this short video, we covered some basics of bond analytics. Again, everything is really just about cash flows. There are more concepts people refer to quite often, such as clean price, dirty price, accrued interest, modified duration, DV01, convexity, day count convention, and so on and so forth. For those, I'll try to cover some other day. Okay, hope you find this helpful. Thanks for watching and hope to see you next time.